Hey there, are you ready to become profitable? Good day, folks. Welcome back to my YouTube channel. I'm Theo, and it's a pleasure having me back on here. Okay, so I've been away from YouTube for quite a while, a long period of time, and a lot has been going on. I basically ventured into a lot of time. It's been like 6 months or years since I've been away. Well, I can't really remember, but I didn't keep track of that basically. But yes, I'm back and I'm back fully. I will be sharing every single thing my experience and everything on my YouTube channel with you guys. Also, dishing out knowledge, dishing out value, content, and all. A lot has happened while I've been away. Instagram banned my account. I gained admission into the uni also. Yes, I gained admission into the uni. I stay alone right now. So those background noises, you won't be getting much of them this time around. And in this video, we'll basically be talking about how to make a successful trade setup, like a profitable trade setup. Trade setups, the process, the approach towards the right trade setup, like to make profits, a crazy amount of profit from a single trade setup. So let's dive right into the charts. I'll catch you there. So welcome to the charts, and like I said previously, I'll be diving into a trade setup so we can all have an idea on how to make profitable trade setups that actually will help us become consistently profitable in financial markets. So the first thing on the list is a defined trade environment. Okay, so talking about a defined trade environment, it's basically what conditions should the market be in for you to place your trade? What conditions should the market really be in before you place your trade? Trading, you understand it's two ways. You're either bullish or bearish. You can't say you're ranging. It's like when you want to place a trade, it's either you're buying or you're selling. So to get the right trading setup, you have to have a defined trade environment. Okay, a defined trade environment. What environment do you want to trade in? Do you want to trade when the market is bullish, or you want to trade when the market is bearish? Okay, so it's either bullish, okay, either bullish or bearish. Bullish or bearish. Now, okay, bullish or bearish. Now, the idea behind being bullish or bearish is to know which of the conditions you want to trade in. In the bull trend, we also have a bear trend in it, and in the bear trend, we also have a bull trend in it. The whole idea is to understand that when we have a bull trend, the bear trend are just retracements or correction to enable us be able to capitalize on the next impulsive move in the bull direction. While basically it's just the opposite for a bear trend, which is every move to the downside and the bear trend is an impulse, then every move to the upside is a correction, which helps or enables us to be able to capitalize on more moves to the downside. So have a defined trade environment. Have a defined trade environment. When the market is bullish, you want to understand you're looking for buying opportunities. High probability trades will fall in alignment of buys, and in a bear trend, high probability trade will fall in alignment to the downside. If you will be looking to take any trade against the bullish direction of the trade environment, which is basically trend is bullish, so you're looking for buying opportunities, and if you're looking for selling opportunities, the reason has to be very, very concrete. Okay, the reason has to be very, very concrete, and if you're willing to take the trade against the initial direction, you must understand you'll be cutting short on your risk. Okay, so that is it on a defined trade environment. That is it on a defined trade environment. Now, define trade parameters. Okay, most people might think this is stop loss or take profit and all, but it's not really stop loss or take profit. It's all about the trade model, the setup. Okay, the criteria is not even criteria. The reasons you might be looking to go higher, the trade parameters. So, for instance, let's say I'm looking for we're in a bullish trend. I'll be looking for BMS higher. That's break in market structure. Break in market structure higher. I'll be looking for potential area of interest. Okay, area of interest that only supports the bullish side. I'll be looking for retracements that will fill in inefficiencies in I'll be looking for all of these things. These are what will help me determine my trade parameters if the direction is bullish. Okay, why do we have to go more higher? Okay, have we seen a structure break higher? Where is the potential area in which when price corrects in the bull trend, I'll be looking for higher prices to look for buys there. Okay, those are the determined trade parameters. Those are what you use to determine your trade parameter instantly. If you don't have an idea of what you'll be looking for when the market is bullish, you have a 0.000 chance of becoming profitable if you trade in a bullish trend. Okay, it's just from the book Trading Psychology, The Disciplined Trader by Mark Douglas. Mark Douglas made something which he said that for you to place a trade, if you're trading a setup, you have to have an idea of that setup beforehand. You have to have an idea of that setup beforehand. That's what Mark Douglas basically said. Having the idea of the setup beforehand means you must have 20 to 40 trade examples where you see this thing pan out. Now that's where the trade parameter comes out, because in every single piece of example you have, you understand what and what to look for. You understand what and what to look for. You understand what and what to put together for that single trade. You understand what and what to put together. So moving on, executable criteria. Now you need to understand that trade parameters and executable criteria for a trade are different. How? The trade parameters sums up every single thing that gives you the model. Okay? The executable criteria means the model in which price comes at. The model in which price comes at. I would like to show you an example. When we have price moving in this type of pattern, okay, we have price moving in this type of pattern, then all of a sudden we move higher, and we basically term this as a break in market structure. Most traders, or every single trader, believe anything formed below within this region is an area of interest. Yes, it's an area of interest. I agree, it's an area of interest, but to understand if the area of interest hold, we moved impulsively away from this piece of price action, and what you will be expecting is the way in which price returns back to any POI you're looking for there. So let's take, for instance, price goes this way, or price tends to move in that area impulsively. I will not be looking at taking that trade. I actually want to see price move quite slowly to that area, which is with less momentum, to understand that selling or buying pressure might come into that area due to the slow momentum. So the executable criteria must be the way price, or how well you are in tandem with price. You need to understand how price moves towards every trade parameter before you can be able to execute the trade. You have to understand how price moves towards every trade parameter before you are able to execute the trade. It's basically understanding the concept behind impulse and correction, and understanding that a correction must not move the same way an impulse moves, unless you might see price continue to trade lower. So, to the next thing, which is why should it pan out? Why should your trade pan out? Why should your trade pan out? Now, I said something on my story quite a few days ago. I talked about price and how it relates, or how it happens in the market. You see, price patterns are repetitive, okay? The model towards price is repetitive. But one thing that can never be repetitive is the result it gives, okay? You see a very, very good setup you trade regularly. It has give you more money from financial markets, and you understand that sometimes the setup fails. So why should the trade pan out? The trade should pan out if all conditions are met. That means this must be met, this must be met, this must be met. Certain conditions like this also must be met. And also, you understanding that every single trade is based on your own sentiments and never against your plan. Understand every single trade is always in probabilities. It's either you come out in profit, the market rewards you, or you are humbled by the market. Either ways, you have to understand that the market moving patterns, they repeat themselves in different time frame the same way, but you just have to understand it's made up of every single factors like everything we've talked about. It should pan out because of all criteria are met, and also you not basing all expectations on this trade has to pay you out, or it has to give you, or you have to cash out on it, or you have to make money off. Keeping an open mind on trade helps you better yourself and helps you understand you should be ready to take the next trade, even if the current trade is running in a loss and it has hitting your target which is stop loss, or your target which is take profit. And also you should be ready to take the next trade and not ponder over the trade that is in a loss over and over again. So the last thing to complete your trading setup, which is like for best max optimization or craziest of optimization and understanding it better, is to journal for future reference. Have a notebook, have a journal, have a hardcover book to actually write these things down. Okay, you could do it the old school way, which is to write it in a note, or create a journal on Notion, or use your iPhone notes if you're using an iPhone, iOS actually, or use your Android notes to journal your trades and actually back them up to a Google Drive. Okay, so I believe all this would help you to understand components of a trade setup better and how you should approach them. Catch you in the next video. Bye for now.